Good morning, afternoon, and evening. My name is Stefan Bartle, and this is the Economic Podcast for Gen Z. Hello. Thank you for tuning in to the Economic Podcast for Gen Z. Today's topic at hand will be dealing with the tax exodus from some states in the United States, such as California, to others. And with me, a very special guest, David Lesperance. Mr. David, I'd like to first begin by saying thank you for joining the show. If you could please introduce yourself to the audience, and then we can get this show on the road.
Sure. It's a pleasure, Stefan. I am a Canadian, child of the auto industry. I grew up in Windsor, which is only 1 mile south of Detroit. My father would wake up in Canada every day and go work in the US. Um, Been dealing with clients, American clients and international clients for over 3.5 decades. Increasingly, I do a lot of, for example, Silicon Valley clients. Many of them are Gen Zers. I also have a nephew, Gen Zer, who's a veteran of YouTube and Dropbox and Netflix and things. So quite familiar with the issues of young professionals and founders moving into the U.S. and moving around within the U.S.
David, it's honestly a pleasure to have someone such as yourself on to help kind of explain what's going on in the current culture concerning tax the rich and a lot of just different topics such as wealth transfers going on. And as Gen Z enters the workforce, these topics are more and more relevant. Maybe we can start with some big questions such as why do you think there are such a phenomenon to tax the rich at such a large level?
Well, at first, I want to start with I'm a Canadian. I've
Mhm.
lived in the UK and I live in Europe right now. So I've always lived in a country which had a national health service. I always opted to spend money on private health coverage, but I kind of like the idea that my, taxi driver or person serving me a dinner at a restaurant is in one health event away from bankruptcy. So I have no problem with the use of what we'll call the golden eggs. Um, the problem with a wealth tax is that it is an attempt that the golden geese in a modern age have wings. They have options. And we'll talk about who's moving out of California and who is not moving out of California. We'll talk about different states and we'll talk about a federal wealth tax. But if we start with the premise that they want to raise money for good things, good stuff. I don't have a problem with that. Is there waste and fraud in California or any government? Of course, it's part of an organization. There's always going to be fraud. Should that be stamped out? Sure. But you still need golden eggs for good money, for good things. Likewise, if you look at just the way the world works, is 75% of the people in the United States don't have an extra dollar of disposable income to contribute to the more golden eggs. So you have to kind of fish where the fish are. My problem is, and the problem with a wealth tax is, as a mechanism to get those golden eggs out of the geese. There was during prior to Napoleon, there was a finance minister who said the art of taxation is getting the maximum number of feathers out of the goose with the minimum amount of hissing. Today, it's getting the maximum amount of golden eggs without the golden geese flying away. Because unlike in the time of the French Revolution, where wealth was in real estate, which you can't put in a suitcase or trade on Bloomberg, today, the vast majority of wealth are in what are called intangibles, things that can be moved very easily and very quickly. So if we look at the California wealth tax, what it proposes is a 5% tax on the net worth of an individual. They say it's for a one time, but as one of the architects of that, Emmanuel Suez, recently confessed They always meant that as a selling point. They always wanted it to be permanent. But let's use Mark Zuckerberg as an example. 5% of what? 5%. It's only 5 cents, only 2 cents, to quote Elizabeth Warren. But let's look at what the real world example is. 5% of, and let's say that the maximum, most of the wealth of Mark Zuckerberg is in shares in Meta. Well, he owns 13% of Meta on what's called the cap table, or 13% of equity. But he owns 60% of the voting shares. So is it 5% of his 13% equity or 5% of the 60%? Well, the interpretation is going to be done by the California Franchise Board, and it's particularly designed that it's going to be 5% of 60. Well, Mark Zuckerberg and similar people are not Scrooge McDuck. They don't have a basement full of gold coins that they're going to use. So he's going to have to sell shares of Meta and pay a combined 37.1% capital gains tax in order to get the liquidity to pay that wealth tax. So his effective tax is not just 5 cents, it's going to be over 30 cents. And if that's every year, if his net worth is this and it's shrinking 30% every year, that's a major hit. So the question is, who's going to leave? Well, in a modern world, the wealthier you are, Mark Zuckerberg does not need to be in California to make and maintain his wealth. Larry Page and Sergey Brin are not going into the headquarters of Alphabet every day and double checking the coding. So they have they have a very little what's called life inertia. They don't need to be in this particular place. They don't need to be in California. They don't need to be anywhere specifically to make and maintain their wealth. So they have little life inertia. And with such a huge force, Newtonian principles, force overcomes inertia, they're going to move. So when the proposal happened, I had a number of clients who said, okay, well, what does this mean? The proposal was originally made in October, second or third week in October. And they called me right after American Thanksgiving. The Monday after, I got calls from 4 clients. And they said, we have to leave. Now, the original proposal by them said, well, it's going to be the day we announce it in October. Well, the California Attorney General goes, that's not legal. The most aggressive you can possibly get is January 1st. So my clients were calling me at the end of November saying, okay, I need to leave California by January 1st. And one of the proponents of that's, well, just because they have a home in another state doesn't mean they left. And these are multi-billionaires. Do you not think they're going to hire the best state and local tax, what are called SALT lawyers, to tell them exactly what they need to do? Oh, well, it's very difficult to, move that quickly. Do you really think, Mark Zuckerberg filled in his own voter's registration card? Of course not. They all have family offices. It's like having a Formula One pit crew in order to move. So I moved 4 of my clients, actually, no, it was 5 of my clients out before January 1st. Well, between my clients and the publicly known clients, the Sergey Brins, et cetera, that's over $1 trillion of wealth that is left. I'm one person.
Mm-hmm.
There are several of me out there. So, I don't know what the number is. I personally know, if we know the publicly traded ones of my own clients, that's over $1 trillion that have left. That means that $1 trillion that those wealth projections that the proponents said, oh, we're going to get, 10 billion over or 100 billion over 10 years. No, those projections are what are called static projections. Assuming nothing happens, this is what we're going to get. Well, of course, we live in a dynamic world. They're going to leave. My father, who's an engineer, used to tell an old joke about an engineer and an economist are on a desert island with a tin of beans. And the engineer spends an hour kind of trying to figure out, how do we hit this off a rock to pop it, and can't figure it out. The economist says, step aside. I'll deal with this. Said, start with, assume we have a can opener. That's the problem. And so these clients not only left and are not going to be contributing those golden eggs for this good cause, They're also not going to be contributing to the state budget every year, which means that, because, and whether you think it's fair or not, the top 1% of taxpayers in California, federal it's slightly higher, in California contribute over 35% of the annual revenue. Well, my clients aren't going to be contributing to California in 2026 and 27 and 28. That's why Gavin Newsom, who's the governor until November, said, well, this is economic suicide. That's why he opposed it at the state level. So the California wealth tax is a definite own goal. Since we're filming this during World Cup, I'll
The
use the own goal.
The original idea for the US federal income tax was also very minimal, and it was also only designed to, I think, tax, I think, 1 or 3% of a set number, very small. And now it has become this monstrosity that people need accountants and lawyers to understand and to do their tax code. And you really don't know the money you send into the IRS, if it's the correct number or not. Of course, the IRS doesn't have the incentive to help deem if the number is correct or not. My initial fear of a California wealth tax, or if we want to hypothetically propose it for the national level, is that it won't stay for the 1%, that this will eventually trickle down into a larger subset of people. For example, we had mentioned multiple houses. I know, and I've researched many a times, that Bernie Sanders has 3 houses and he's a multimillionaire, and that's on a congressman's salary. That's a magic trick in and of itself. Do you think, or do you also perhaps anticipate that if these wealth taxes gain traction, that they won't only set at the 1%? Do you think they'll also trickle down to millionaires?
Yeah, again, my clients hire me to be like Mr. Spock on Star Trek and to tell them what the current situation is, not what I wish it was.
Mhm.
Tell them what I think the future is going to be, not what I wish it is going to be. So if we follow this logic, the targets of the wealth tax have large numbers of them that have left. They have these projections. So what are they going to have to do? California, it's quite unwanted, but utterly predictable that they will expand the net. So all of a sudden it's going to go down. So we've already seen, for example, Elizabeth Warren at the federal level said, not billionaires. We're talking about 50 million. Gavin Newsom has said it at 100 million. So the impact is it will expand. And again, if you mentioned the income tax was originally, well, it was brought in the last time it was brought in the U.S., brought in for the Civil War, but the last time was to pay for the First World War. Well, that ended over a century ago. So there's always, once that happened, well, then there was a depression, then there was a war, and then there's always going to be good stuff to spend it on. So my clients said, when they said it's the first time, they go, no, or a one time, they said, no, it's a first time, because taxes, once they're implemented, tend to remain. And if this passes, then other unions, which are currently opposing it only because they're not getting some of those golden eggs, are going to say, oh, let's take a bite at that apple. That was pretty good. Now, the impact is it's going to expand. Now, if you're a young, you're starting Stefan AI and you're thinking, where am I going to set that up in? You're going to say, I'm not going to work 80 hours a week and I'm going to set it up in a different place, which doesn't have a wealth tax. Now let's look at the federal level. In order to avoid the California wealth tax, you need to relocate out of California. You're obviously not going to jump out of the California tax pot and into somebody else's tax fire. So you would move to places like Florida or Texas or Nevada, which don't have state level taxation. But at a federal level, if the US federal government says we're going to have a federal tax, which is what everybody from Ro Khanna and Bernie Sanders and Elizabeth Warren and Newsom and name all of the future Democratic presidential candidates have all said we're going to bring in a federal wealth tax. And in fact, the progressive wing of the Democratic Party has said we're going to make this the litmus test for our support for our candidate. So, okay. Now, from a federal wealth tax, you are, in order to get out of because the US has a very unique, we'll move Eritrea aside because it's not really a tax. They're the only country in the world with taxes based on citizenship. Is it fair or not? Own it. That's what it is. It's been that way since the Civil War for historical reasons I could bore you with, but that's what it is. Is it going to change anytime soon? Probably not. So that's, again, what the world is, not how I wish it was. So in order to get out of the US um, tax, you have to give up your citizenship, which means you have to acquire another citizenship. Now, you may have one because you've got a Belgian parent or an Irish grandmother, or you may be ready to become naturalized in another country, or you may get a citizenship by investment, or you may get one by merit. And so that's fire insurance. So I use the analogy that wealth taxes are kind of like a tax the rich wildfire. So how do you plan against that wildfire? Well, yeah, I call it the fire strategy. The first one is fund the firefighters. These are lobbyists who are trying to defeat the California and in turn federal wealth tax. The second is get fire insurance. Well, for a state level, that means getting the ability to move. Well, you can move from an immigration point of view, but getting a home and setting up all your centralized mode of living in another state. That's FIR. The third one is reorganize. Reorganize using all the existing tools, GRATs and the gift and estate tax tools, all the existing legal planning tools to take wealth off the table. And the final is E, escape plan. Have a fire escape plan. Now, in order for there to be a federal wealth tax, you need two things. Number one is you need in 2028, November 2028, you need the Democrats to win majorities in both houses and win the White House. So clients will go, wow, when I have clients say, oh, well, federal wealth tax will never happen. Like, okay, well, again, let's put it in odds. What do you think the chances are that the Democrats will hit the trifecta? And they said 25%. Okay. And what do you think the chances of, if they win the trifecta, that they're going to pass a federal wealth tax? Well, 50-50. Okay, so there's a 12.5% chance that this tax-rich wildfire is going to hit your fiscal house and cause this damage. Would you spend this much on a fire strategy? Of course, there's a 12.5% chance of an actual wildfire is going to hit your house. Would you take out fire insurance? Of course. So that's what we're doing a lot of, is fighting the fire, getting the insurance if they don't already have it, reorganizing their affairs, and we're doing succession planning and other things at the same time, and getting a fire escape plan. You cannot try to do this the second week in November of 2028 and say, oh my God, they hit the trifecta, and oh my God, they're actually going to wealth tax. Get me out of here before the inauguration. It's too late. You can trigger a fire escape plan, but you can't build one and then trigger it in that short a time.
So what I'm hearing is that there is a lot of planning 2 years in advance by a lot of people who are aware of perhaps a coming avalanche for 2028, and that they're preparing now for this. And I mean, I've read many things that more people than ever are seeking UK citizenship, Irish citizenship, to at least attain a second passport and to perhaps move their tax base or rescind their US citizenship. Just shortly to put the economics in this podcast, for me, I was always a huge, I don't know, fan, but I always admired the Laffer curve in that it simplified the system radically. Milton Friedman used it many a times when he was very prominent in the 70s and 80s. And
Mm-hmm.
the largest benefit for me is what I can see is that one does not need the entire, perhaps I will call it incentive structure and bureaucratization in the IRS, in the lobbying, in to determine what tax credit deductions one needs or one gets, or how many kids one needs to have in order to make this amount, or if you make $1 over six figures, you're in a different tax bracket. All of this gets eliminated with a flat income tax. And with the Laffer curve in and of itself, for me, I'm almost looking at these wealth taxes as a way to rally a base, in that there is a clear, perhaps, enemy or subsect of the American populace that have a lot, and that they are deemed as not paying their fair share. Their fair share has never been identified, which is very convenient for politicians to always move goalposts. And for me, the Laffer curve is so beautiful in that the higher the tax rate, the less income the government receives, and that a flat tax base, even at the state level or at the national level, would simplify very quickly not only the confusion that people need to know what they owe the IRS or what is being taken from them, or perhaps from Rothbard standard, what is being stolen from them. And in addition to this, there is also no opaqueness in the system. I agree with you that there are systems that we want and desire, and the systems we live in. The fire plan that you had just laid out is very nice, very acronymical, very clear, to the point. For me, do you think this more or less will maybe be experimented with at the state level, or do you see this more as a top down from the federal level?
Well, for all the reasons that we talked about, a state wealth tax is always going to be ineffective. Just because, and there's another fellow Canadian, Christabel Young, who keeps talking about the myth of I co-authored a book with a London School of Economics professor called "Flight of the Golden Geese" over a decade, and he wrote about the same time a book called "The Myth of Millionaire Flight." Well, millionaires have a lot of life inertia, and he looked at a study in Massachusetts. So if you are a dentist in Massachusetts, you have a lot of life inertia. You have a home, you probably own your building, all your patients all live within 5 miles of your office. You can't pick up and move to Miami and reproduce your wealth. So you have a lot of life inertia. So a few points of income tax is not going to be enough to make you move. But again, we're talking, people worth minimum 50 million. And a lot of those people, and he also looked at all your connections, your social connections, et cetera. Yes, if I'm a lawyer in in New York City and I have to meet all my clients every day in order to have my business, I may not be able to move as much. But in a modern world, I can tell you, all the tax lawyers I used to talk in New York are all in Florida now because we have things like Zoom, Slack, email. you know People are used to since the pandemic working remotely, so why would you work in a jurisdiction which is going to tax you a high amount? Now, you talked about the Laffer curve, which is interesting. I would encourage your listeners or your viewers to Google. There was recently a debate at Berkeley. I think it was called Clash of the Titans, with Arthur Laffer and with Emmanuel Suez, who is one of the authors of the wealth tax. And you can draw your own conclusions. My conclusion is, I think Arthur Laffer wipes the floor with him. But anyway, now going back to, let's say that there are good things for that whatever that is, and only the golden geese have extra eggs to contribute. What is a way? The term paying their fair share. That's like, Stefan, you've got a bad attitude. What does it mean? Let's move from the subjective to some objective amount. Is it a percentage of your income? Is it a percentage of your wealth? And in a modern world, income tax, so I'm going to throw one equation at you. X, which is what's taxable, times Y, which is the rate, equals Z, or Z for American audience, which is the dollars paid. As a tax, as a government, you want to maximize, Z. So what is Y? Y is the income tax rate or capital gains rates. Generally, capital gains are taxed at half of what income tax rates. One of the things they talked about is making the capital gains rate higher. What is taxable? Income. If you have you work at a job and you have an income, that is going to be taxable. Or if you have capital gains that are taxable. When are capital gains taxable? Right now, they're taxable when you actually sell. So there is you. I would also encourage people to listen to Professor Ray Madoff has written a book, and she talks about taxation. But most of the wealth of people like Zuckerberg, if we look at Jeff Bezos only draws 86,000 a year in income. All of the wealth is the appreciation of his shares in Amazon. So how do you tax that? Well, you can try to take it with a wealth tax, but Jeff Bezos will leave. Okay, he can sell shares and he'll pay whatever the capital gain rate is, and you'll generate money there. But he's not selling, he's borrowing against it. Okay, then you're probably more useful to pass a law like Bill Ackman has suggested, which is you're going to tax if you borrow against assets, that's a taxable event. You'll pay capital gains tax. How do you determine? Well, if you sell it, you know what the fair market value is because the buyer said it. If you borrow against it, you know what the fair market value is because the lender has sent a loan to value on it. Or if you die right now, if you die, you get a step up in death. Other countries don't do that. For example, Canada says if you die, that's a capital gain event. If you leave the Canadian tax system, whether it's an exit tax, whether that's an exit because you got on an airplane or because you went feet first into the ground, that's an exit. So those are probably ways. But people like Bernie Sanders say, well, I don't, you know, no, that's too long. Well, from the golden goose point of view, they can say, look, I have no control over when I'm going to die. It's an event certain with an uncertain event date. But if I want cash, I can sell shares in Stefan AI, but maybe I don't want to do that because I think it's going to greatly appreciate, or I think it's going to, it's a control element. So I can borrow against it. Either way, I can define it, but that's in your control. Or you can say, I don't need the extra cash. I live a quite frugal lifestyle. That's completely in your control. They don't like it because it's in your control, but that would be much more acceptable to the golden geese. And remember, you know, I was going to leave because I don't like the tax, but 80% of my neighbors think I should pay it, so I'm not leaving, said none of my clients ever.
The fun part about capital gains taxation is that no one ever really wants to approach the other side of that. What happens if I lose money and then I sell? Does the state reimburse me then? No one's ever yet to come up with a side for that.
Well, and it's interesting. Bloomberg just interviewed a one of the big VCs, Kanoshi, and he said there used to be. You're quite right. If I'm drawing a salary, I know every second Friday I'm going to get X amount of dollars so long as I show in. If I invest in, Stefan AI, may go up, may go down. I'm not guaranteed a return. So there's risk capital. So should I be rewarded with that at a lower rate? That's an interesting discussion. I would say yes, but that's at least an area of discussion. And I would encourage people again to listen to that Bloomberg, and you can hear the other side. But that's a policy decision. Those are discussions which people can agree with or not agree with. Wealth tax is where you're just going to grab it, and I don't care what the golden geese say. Well, guess what? The golden geese, remember, there's lots of other jurisdictions. In the case of a state, that's the Floridas and the Texas and Nevada, say, you want to leave California? Come here. We've got a greater deal. We'll welcome the golden geese. Other countries have said, US wants to tax the golden geese to an unacceptable level to you, the golden goose. Well, lots of other countries will attract you. And another Berkeley academic who doesn't live in the real world, Gabriel Zuckman, says, well, we're going to have a universal billionaires tax across the so you can't go anywhere. Well, Professor Zuckman, I know you're bucking for tenure, but let me introduce you to a gaming theory called the prisoner's dilemma. Lots of jurisdictions are saying, you want to try to squeeze your golden geese to the point where they want to leave? we'd love to have them here, and we'll cut a better deal than you're proposing for them. So lots of jurisdictions around the world. And I'm not talking about desert islands, I'm not talking about Pitcairn Island. I'm talking about lots of other countries, you know, lots in Europe. Even Canada doesn't have a wealth tax or an estate tax, and you can do planning. So there's lots of jurisdictions that people can quite comfortably live their entire lives and reproduce their lives and have everybody in the family happy with a significantly lower tax bill. Let's look, for example, at Italy. Italy says you pay 300,000 euros a year. Whether you make a dollar or 300 million, we don't care. 300,000. Well, guess what? You're now not paying Price Waterhouse to do your compliance or to do your return. You're not, when they hand you that 50-page return going, I hope you got it right. So there's no compliance anxiety, it becomes a line item. Now, why would Italy do that? Well, because Stefan is going to contribute 300,000 to the coffers. It's not like we have to hire another police officer or pave another mile of road. So there's no marginal cost to having Stefan here. He's paying 300,000, which is 15 times what the average Italian pays. That's great. And Stefan's going to have an espresso and biscotti for breakfast. Well, he's going to pay 23% VAT tax on that. So there's no downside to Stefan, let alone he's going to spend money, let alone he's probably going to bring all his capital here, etc. So it's a win-win. But other countries like the UK closing off their non-dom and changing their inheritance tax rules, or the US. And I will often get Americans who say, Americans, and I understand, I am about halfway through Ken Burns' American Revolution. I probably watched more Ken Burns documentaries. I've spent my entire life a kilometer away from the United States. I've been dealing with it. Half of my siblings are Americans. So I'm not saying I'm de Tocqueville, but I've been watching the American experience, as PBS would say, for my entire life. I get it. Pledge allegiance to the flag of the United States of America and to the Republic. I got 24 out of 25 on the New York Times list of questions for the 4th of July. I get it. Americans have an extraordinary connection to the United States, but, and I have clients, I'd never give up my U.S. citizenship. Well, you know what? Do you realize that the majority of the world's billionaires and wealthy have never had an American passport, and they managed to live a quite comfortable life? I can tell that, in close family members have had it, that have helped them give it up, they live quite comfortably. Thank you very much. They go, oh, well, there's an exit tax. But yes, when you renounce your citizenship, there is something, or 877A, there's an exit tax, which is a one-time tax, top federal rate, 23.1% of your unrealized gains. One and done, just on unrealized capital gains. Or would you rather stay and pay Bernie Sanders 5%, plus you got to pay the capital gains to get the liquidity for the rest of your life? And you're working out and you're eating well and you're hoping you're going to live for a long time. So your wealth every year is going to shrink. And so will people leave? Well, if they have fire insurance and a fire escape plan, you'll see that decision in November, December of 2028. What impact will that have on the United States and those left behind? Well, at a federal level, the top 1% contribute 43% of the total annual collections. And that's, now we're talking about the top 0.01 or well, it's skewed. The model is skewed. Whether you think it's fair or not, that's the way a progressive tax system works. So it's going to have an enormous asymmetric negative impact on future tax revenues.
David, this has been an absolute phenomenal conversation as we're winding down here. I, for one, have learned a lot, and I think many of the audience can take a different perspective here. Where can my audience members find you? Where are you active? What are you currently working on?
Sure. So I'm very active on LinkedIn. I'm posting several times a day on kind of what's happening in the world. They can also go to my website, which is Lesperance Associates, and Stefan, you'll probably put that in the
Yeah.
links for that, and you will see I have a very active media and blog section, and also you will find this and other podcasts and webinars on there. So roam around, and if you want to reach me, you can do so either by clicking on the form on the website, or sending me an email at David at Lesperance Associates, or sending me a message on LinkedIn.
Thank you very much, David. This has been an absolute pleasure.
Great. Thank you, Stefan.
For those listening, I want to say thank you for tuning in. You can, of course, follow this episode on Spotify and other streaming services. We are also active on LinkedIn and Instagram, waiting for your follow and subscribes. For any comments and inquiries, please reach out to us at the Economic Podcast for Gen Z at gmail.com. Thank you so much.
Thank you.